In this lesson, we're going to cover the main trading costs and fees that are associated with trading a live account, namely commissions, spreads, and swap during the daily rollover. Now, to understand how spreads work, first we must have a basic understanding of market liquidity. So market liquidity is essentially the amount of demand and supply in a market. So it's the ease to which a market can be traded without affecting its price. So this diagram illustrates what liquidity looks like in terms of an order book in the market. So each of these horizontal lines, they represent a price level in the market. So if a market is very liquid, there will be bids and offers at every price level, but also with a large amount of volume at each of those levels. So for example, if you've ever clicked buy or sell with a market order on a very liquid instrument, let's say euro dollar via your broker, then you likely would have got instantly filled. And that is because it's an extremely liquid market, and there will pretty much always be enough liquidity on the other side of your order to instantly fill your trade, especially if you are a retail order and you're not trading with absolutely massive size. However, with a liquid markets, there may not be any bids or offers at certain price levels, and or the quantity of supply and demand may be much lower too. So a typical example of quite an illiquid market would be the housing market. If you put your house up for sale, there will not instantly be someone outside your front door, ready to buy with the exact asking amount in cash in their hands, would there, right? So in the FX market, illiquid market conditions are where you will often see where price kind of gaps up or down to fill the next best available order. Because remember, for every buy order in the market to be filled, it must be matched with an equivalent sell order, and vice versa. For every sell order in the market to be filled, it must be matched with an equivalent buy order for a trade to occur. Now, we do not view the full depth of the order book. Instead, our broker will just show us the current best market bid and ask price. And the difference between both of those is the spread. Now, the primary way brokers make their money in the Forex market is on the spreads of currency pairs. So it's wise to develop a solid understanding of spreads. So obviously, all Forex prices are quoted with two figures, where we have the bid price and we have the ask price. Now, the bid price is the price at which you can sell to the market, and the ask is the price at which you can buy from the market. So you buy at the ask and you sell at the bid. Now, an easy way to remember this is to ask yourself, what is the market doing? So the market is asking for, or the market is bidding at. Because you can only buy at what the market is asking, so you buy on the ask price, and you can only sell at what the market is bidding. So you sell at the bid price. Now, if this is a bit confusing at first, just try to think of it like eBay, where essentially you sell to the highest bidder, or you buy from the market at the price the seller is asking for it. Now, most brokers make it extremely simple these days anyway. They literally just have a buy and a sell button, so it's almost impossible to get it deliberately wrong. Now, one thing to note is that the ask price is always slightly above the market price, and the bid price is always slightly below the market price. So when you are looking at a price quote on TradingView, for example, right, when you're looking at your price chart, you will only ever see one price on the right-hand corner, right, that the price is at, and that is essentially the market price, or in other words, it's the mid price. So that's halfway between the bid and the offer. And it's this difference between the bid and the ask price that is obviously known as the spread, and the spread is essentially the transaction cost of trading. So in this example, the bid price for euro dollar is at 1.18356, and the ask price is at 1.18362. So just really the difference in the micro pips there, right? So it's a spread of 0.6 pips. So on TradingView, if you were to look at this, it would just show the mid price, so halfway between, which it would show is 1.18359. Now, if you were to go long on euro dollar, right? So let's say you buy euro dollar, then you would be buying at the ask price. So you go long at 1.18362. Remember, we buy at what the market is asking. Now, the very second that you actually execute that trade, right? So you've gone long at the ask price. At that very, very second, if you were to look at your brokerage platform, you will instantly, at that very second you entered, you will instantly be in a minus 0.6 pip floating loss. Now, the reason why you're instantly at that loss, the size of the spread, is because for you to exit the trade, right, you need to sell your position at the bid price. Remember, we can only sell at the bid. So the moment you enter the market, you're going to be in that 0.6 pip loss because that's the size of the spread, right? That's the difference between the ask and the bid. And to exit out of your position, you need to sell at the bid, which is 0.6 pips lower than the ask price that you bought in at. So that's why the spread is your automatic cost of doing business to enter a trade. Now, slightly increasing the spread beyond the cost price, that is one method by which brokers make their money. So given the nature of the Forex market, spreads are obviously constantly changing because the market's dynamic and price and volume are fluctuating throughout the day. So the more liquidity that there is, the more buyers and sellers that have their orders in the market, then the tighter the spreads will be generally, right? You'll get those narrower spreads, the more liquidity that there is. So the major currencies have a higher trading volume than, those sort of smaller and more obscure exotic pairs. So therefore the majors generally have those lower and narrower spreads. And obviously lower spreads, that means lower transaction costs for us as traders. So that's why we stick to the major pairs. Now, to calculate the total transaction cost, you can use this formula. So it's the commission plus the spread times the monetary pip value, and that will give you your total transaction cost. So let's say, for example, your broker may charge a commission of $3 for a round trip. Now, a round trip, all that means is it's essentially the full cost for both entering and then also executing your position. So essentially it's just that total sort of cost in terms of your commission. Now, let's say the spread at the time of the instrument that you were trading is 0.6 pips. Now, if you have a position size of 10 lots on that trade, remember one lot is $10 a pip on a USD pair. So that means 10 lots is $100 per pip. So that means that the transaction cost will be the $3 commission, right, the round trip, plus the spread of 0.6 pips. And then you multiply that spread by the monetary pip value, which in this case will be $100. So that means that the total transaction cost is $63 to execute that position. Now, what you'll find is that some brokers, they don't actually charge a disclosed commission. So they might tell you that they have 0 commissions. But generally, when they do that, the majority of their revenue will come just from the spreads alone. So what that means is those brokers who don't charge a flat commission rate, they generally tend to have much wider spreads than the brokers who actually do charge flat commissions. And those brokers who do charge them, they tend to have narrower spreads. But generally, the total transaction cost will still be the same between those different types of brokers. So it's just down to your preference, which style you prefer. Whether you kind of prefer those narrower spreads, but then you'll kind of have that flat commission rate, or whether you're kind of happy to have the wider spreads. But generally, the costs will be the same. Now, aside from spreads and commissions, there is one other fee that you should be aware of in your trading business, and that is something called swap. So swap is the interest fee that is either paid or it's charged to you at the end of each trading day if you keep your trade open overnight. So in Forex, when you keep a position open through the end of the trading day, you will either be paid interest or you will be charged interest on that position, but it will depend on the underlying interest rates of the two currencies in the pair that you were trading. So at 10 p.m. GMT every weekday, the broker rolls your position over to the next trading day. So for example, let's say that you've got an open position on day 1. If you decide to hold this trade over into the next trading day, you will either pay or receive swap on your open position. Now, when you are trading on margin, so we are leverage trading, right? You will receive interest on the currency that you are long, but you will pay interest on the currency that you are short, right? Because you are borrowing that currency to go short. Now, the net difference between those is known as the carry, and traders are seeking to profit from this are known as carry traders. So positive carry, that results when you receive more in interest than you were required to pay, and it is added directly to your account. But then the flip side to that is if the net carry is negative, then obviously it is subtracted from your account. So for example, let's say you short pound dollar. And let's just say, for example, that the Bank of England at that time is paying out 0.1% interest, but maybe the US Federal Reserve, they are paying out 0.75% interest. So if you are short pound dollar, that would actually be a net positive carry trade, and you will earn 0.65% interest on your position each day. Because when you are long the currency that pays a higher interest than the interest charge of the currency that you are short, then that is why it is a net positive carry. Now, in reality, it is slightly harder to calculate the exact carry that you will earn or pay, because most brokers, They tend to charge a very small markup fee for overnight swaps, and there are a few more steps to the calculation. So if you are interested in learning a little bit more about this, I will post a link to an article in the lesson notes for you. Also, each broker will have a lot of detailed information on how they calculate swap fees for each pair. So just ask your broker for this if you do want to check it out. But the key takeaway that I kind of want you to learn and kind of be aware of with swaps is that if you are planning to hold a position for a long time, if you're more of a swing trader, this doesn't really apply so much to kind of day trades. But if you are kind of swinging that trade, but you're in a position where you're paying a negative swap, then you're obviously going to want to take this into consideration, because after a while it really can start to kind of slowly eat away at your profit. If the trade's not really going in your favor and it's kind of just going sideways for a long time, that's going to really start to chip away at your P&L. So it's not something massively to worry about, but unless you're kind of a really long-term trader, as it's nearly still always very minimal, but you should be definitely aware of it. Now, one last final thing that you should be conscious of is that when the daily rollover happens on the market close at 10 p.m. GMT each weekday night, because at that time, a lot of market participants, they don't want to pay the swap on their positions. So what they'll do is they'll exit the market, and then a lot of orders are also temporarily pulled. So what this means is that about an hour each side of the daily close, market liquidity is extremely thin. So the spreads widen dramatically. Now again, this varies from broker to broker and currency pair to currency pair, but I have seen some pairs widen as much as 30 pips. So a general rule that I think is really important to have in your trading plan is to never enter positions between 9 and 11 p.m. GMT, because you just do not want to be paying a ridiculously wide spread unnecessarily. Because I've seen a lot of new traders do this where they just have no idea that this happens, or they forget, and they even enter a trade around this time, let's say with a 5 pip stop, but the spreads are actually 10 pips, and then they get in, they instantly take a loss, and sometimes even worse, they get slippage as well. It's just you don't need to be doing that, so just make sure that is in your plan. So just wait at least an hour after the daily close until you see those spreads start to calm down again, and you'll see them start to narrow and come in a bit. So obviously take into account daylight savings when that changes twice a year, in terms of when the daily close may shift an hour forward or back for you. So also just keep an eye out on that. So that wraps up the fees that you should be aware with your brokers. Generally all of the major regulated brokers are extremely competitive on their fees. And you're trading Forex, especially compared to kind of other asset classes such as stocks and whatnot. Forex, in today's modern age, is probably the cheapest market there is to trade by a long way. You really don't need to spend too much time worrying about the fees, but obviously it's pretty prudent to be aware of what they are, how they work, and certain times of the day to avoid placing trades.